Today we'll be reviewing my analysis made on tradingview.com about the American market, in particular about the Nasdaq, where I've been suggesting a short last week. Actually, last week I've read and I've seen so many articles and videos where the big traders, especially American ones, were predicting a Christmas party for December. So they were suggesting to buy stocks. And since they were thinking to see the market going up in December, which is not happening. So I was right. I've been suggesting to short the market because if we have a look to the monthly MACD, we see that this indicator has reached the same amplitude which was in 2000 before the collapse of the internet bubble. I've been writing, okay guys, if you don't want to wait 15 years to recover your losses or to see the same prices, unless exactly you don't want to lose money, the only way to make money in the market is to going short, actually, unless you want to buy some put option. So actually, it's not, this is a technical analysis. It's a technical reason. There is another reason which is fundamental one. It happens only once in the history, exactly before 2000 again, when we had a price against earnings equal to 30. So again, in 2018, the average price against earnings for the Nasdaq companies in 2018 is equal to 30. So actually, it's a bubble, it's a big bubble. Let's not forget that even Warren Buffett said this a few months ago. And to me, it's extremely risky to buy stocks at this level. The same FANG companies, so Facebook, Amazon, Apple, Netflix and Google, let's not forget they are already down 30% from their highs, which should tell you something. And once we analyze the COT report, which give us the positions for large traders and commercial traders and as well for small traders, I've noticed that large traders over 2018 have started to reduce their positions, which means reduce both long and short. The same for commercial. We know that the small traders are normally between the large traders and the commercial, but this also, if we have a look to the volumes for the futures in 2018, we will see that they are much lower than the same volumes in 2017. This actually, what does it mean? Actually, it means that the large traders or the strong hands, actually those one who have the real money, the real power, have started to sell their stocks on the market. So they are in order to either being more liquid or to buy the treasury bonds. Okay, now there is another important fundamental fact that happened last week. So the treasury yield bond at 2 years is now inverted against the 5 years. So the 5 years was worth less than the 2 years. Normally this is a anticipated recession, okay? But let's not forget, when we talk about stocks and market in general, financial markets in general, they anticipate the real economic recession. So normally the anticipation is something around between 6 and 12 months. Then, coming back to the technical analysis that I've done on that article, I've realized that in February 2018, always looking at the monthly chart, I've realized that there is an hanging man, which means, in other words, this is a price action, okay? So price action is something that normally people doesn't understand. That's why they often lose money. We know that 90% of the people trading in the market, or the traders, let's call it small traders, lose money in the market, is because they don't know actually anything about price action. So they don't know how demand versus offer work, and actually they don't know anything about money management. So they don't know when it is the moment to take the losses, because they are eager, they hope that those losses will be turned into profit one day. But normally it doesn't work like this, because those losses get bigger and bigger, and they don't know when and how to take profits. Okay, so the price action, coming back to the price action in February 2018, I've detected hammer, which is what is a hammer? Hammer is actually a Japanese candlestick, which means that bulls have tried to push the quotation higher. So I'm talking about the Nasdaq 100 index. And then after, but with the closure below the high, okay, for that month. Afterwards, we've seen a series of long white candle, and then we've seen an evening star, which is a formation based on three candles. So we have a first candle, which is a long white candle. Then we have a doji candle, which means uncertainty. So the bulls and the bear, are there, and there is uncertainty. So they don't know in the market who is the winner between bulls and bears. But the third candle is the most important one. Is a bearish candle, is a long black candle with a close closing below the close is the low of the month. So that one is an extremely important candle, and it is a very negative one. Then another fundamental analysis, another fundamental fact. Only once in the history, sorry, only once in the history before 2018 we have seen price against earnings equal to 30. Okay, it was in 2000. So before exactly the collapse of the internet bubbles. Actually, what does it mean? It means that we know that after the collapse of the internet bubble, only after 2 years the company were worth 90% less. Okay, which is an incredible data. So when you read those articles, for example, Market Watch has been so bullish. I've read so many bullish articles in December, at the beginning of December, and nothing happened at the end. It happened exactly the opposite way around. So we had a bloody week with the market collapsing. So the last closure for the Nasdaq on Friday was minus 3.30%. For the Standard & Poor's 500 it was minus 2.50. So it has been a very bloody week, with the exception of Monday, okay, where we had a gap up. By the way, so we have so many indications that to me are anticipating a big drop down in the market. I've been posting several articles stating that the market will be collapsing, and it will be a very tough one in 2019 and 2020. So I'm really extremely pessimistic, but in any case there are opportunities to make money again buying put options or opening short. But we have to be careful, because even in a bearish market, that the volatility is higher than during the bullish market. Okay, so during the bullish market we have higher high and higher low, but normally the fluctuation is much easier to be controlled, okay, in terms of stop loss. During a bearish market, the volatility increases. Even during the bearish market, we might see movement like 2 or 3 months movement, where the market can go up for 30 or 40%. That's because there is a lot of volatility. So once we open short in a bearish market, we have to set up stop loss, which have to be much farther than it could be during a bullish run. So really, so many reasons why, again, treasury bond, 5 years treasury bond, the treasury bond inverted against the T1. Then the monthly MACD, which has reached the same level which was in before 2000. And then those large traders who have reduced their positions over 2018, and the volumes on futures and options in 2018 are much less that we see in 2017. I'm really let's not forget that even Warren Buffett a few months ago said that the American market is a bubble now. But and then of course, lastly but not least, we will have an increase on the interest rate. So we will have another 0.25 increase rate in December from Jerome Powell for the Federal Reserve. So many reasons why I don't expect to see, well, and obviously, since if we have looked to the expectations for the like 2019, if the 80% of people is stating that the market will be going up, it means that most probably it will go down. Okay, see you guys.